Let's begin with last month's forecast performance. How accurate was the forecast overall?
Overall, the top-line forecast was reasonably accurate from a revenue perspective, with total revenue finishing approximately 3% above forecast. Occupancy exceeded expectations due to stronger last-minute MICE and corporate demand. However, there were notable variances within ADR and operating expenses. ADR performance was softer than anticipated because of increased promotional activity and competitive pricing pressure. In addition, payroll and utility costs exceeded forecast significantly, which negatively impacted GOP flow-through.
Which forecasting assumptions turned out to be incorrect?
The primary forecasting gap involved ADR assumptions. We anticipated stronger pricing power during weekday periods, particularly within the corporate segment. However, market competition became more aggressive than expected, resulting in higher discounting activity. Another assumption that underestimated actual performance was MICE demand, which recovered faster than forecast during the second half of the month. On the expense side, utility inflation and overtime requirements were also higher than projected.
What external factors impacted performance the most?
Several external factors influenced business performance. First, market competition intensified due to aggressive pricing strategies from newly opened luxury properties. Second, corporate travel demand recovered faster than expected, especially from regional markets. Third, inflationary pressure continued affecting utilities, imported goods, and labor costs. In addition, economic uncertainty remains a factor influencing booking patterns and short-term business visibility. These conditions created both opportunities and forecasting challenges.
How often should forecasts realistically be revised?
Given current market volatility, rolling forecasts should be reviewed at least monthly, with more frequent updates during periods of significant demand fluctuation. In hospitality operations, booking pace, market conditions, and operational costs can change rapidly. Therefore, forecast flexibility is extremely important for maintaining financial visibility and operational responsiveness. Weekly forecast adjustments for occupancy, ADR, and labor planning may also be beneficial during high demand or uncertain periods.
Which departments tend to provide the least accurate forecasts?
Forecast accuracy challenges usually occur in departments with highly variable operational activity. Banquets and F&B operations are often the most difficult to forecast accurately because demand can fluctuate significantly based on event business and guest spending patterns. Payroll forecasting may also become less accurate when overtime and casual labor usage change unexpectedly. However, improving cross-department communication and forecasting discipline can significantly reduce forecast variance over time.
If forecast accuracy is weak, how can ownership rely on financial projections?
That is a very fair concern. While forecasting can never eliminate uncertainty completely, the objective is to provide the most realistic business outlook based on available operational and market data. In today's environment, flexibility and responsiveness are just as important as precision. We are continuing to strengthen forecasting methodology through improved data analysis, closer operational coordination, and more frequent rolling forecast updates. The goal is providing ownership with timely and reliable financial visibility for decision-making.
What should be our top forecasting improvement priority moving forward?
I believe the key priority is improving alignment between operational assumptions and financial forecasting. Stronger communication between revenue, sales, operations, HR, and finance teams will improve forecast quality significantly. In addition, more detailed analysis of booking pace, market segmentation, labor trends, and operational costs will help strengthen forecast accuracy. Finally, maintaining a disciplined rolling forecast process will allow the hotel to respond more effectively to changing market conditions.
Can GOP forecasting improve?
Yes, I believe GOP forecasting can improve through stronger operational alignment and more dynamic forecasting methodology. Revenue forecasting has become relatively sophisticated, but GOP accuracy often becomes more challenging because expenses can fluctuate quickly based on occupancy, labor requirements, utility consumption, and operational activity. Improving communication between finance, operations, HR, and revenue teams will strengthen forecast assumptions significantly. In addition, frequent rolling forecast updates and scenario analysis can improve visibility and reduce unexpected variances. The objective is not achieving perfect precision, but improving responsiveness and business visibility.
Why were expenses underestimated?
Several factors contributed to the expense variance. First, operational demand increased faster than anticipated, particularly in areas requiring additional labor and overtime support. Second, inflationary pressure on utilities, imported products, and operating supplies remained higher than forecast assumptions. In addition, certain operational costs become more difficult to predict accurately during periods of volatile occupancy and changing business mix. Moving forward, stronger coordination between operational planning and financial forecasting should help improve expense visibility and forecasting accuracy. How reliable is the next quarter outlook?
The next quarter outlook is reasonably positive, although market conditions remain dynamic. Current booking pace, corporate demand trends, and MICE activity provide encouraging indicators for top-line performance. However, external factors such as economic conditions, competitive pricing pressure, and cost inflation continue creating some forecasting uncertainty. That's why we are maintaining a rolling forecast approach with regular updates based on real-time business developments. Overall, the outlook is cautiously optimistic, but flexibility remains important.
Should ADR assumptions be more conservative?
I believe ADR assumptions should remain realistic and market-driven rather than overly aggressive or overly conservative. In volatile market environments, pricing assumptions should carefully consider booking pace, competitive positioning, market segmentation, and demand visibility. Overly optimistic ADR assumptions may create unrealistic GOP expectations, while assumptions that are too conservative may limit commercial opportunity. The most effective approach is maintaining flexibility and adjusting assumptions dynamically as market conditions evolve.
How should market volatility be reflected?
Market volatility should be reflected through scenario planning and more flexible forecasting models. Rather than relying on a single projection, hotels should evaluate multiple business scenarios based on occupancy, ADR, and operational cost fluctuations. Shorter forecasting cycles and closer monitoring of booking trends also improve responsiveness during uncertain periods. In today's hospitality environment, adaptability is becoming just as important as forecast precision.
Can labor forecasting improve further?
Yes, I believe labor forecasting can continue improving through stronger operational coordination and more detailed business visibility. Labor demand in hospitality is highly connected to occupancy, banquet activity, guest mix, and service expectations. More accurate scheduling forecasts, earlier event visibility, and closer coordination between HR operations and finance can reduce labor variance significantly. Technology and automated workforce planning tools may also improve manpower forecasting accuracy over time.
How do we reduce forecast surprises?
Reducing forecast surprises requires earlier communication, stronger data visibility, and more proactive operational planning. Many forecast variances occur because business conditions change faster than assumptions are updated. More frequent rolling forecast reviews, closer cross-department coordination, and real-time operational reporting can help identify risks earlier. In hospitality operations, forecasting should remain flexible and continuously adjusted rather than treated as a fixed monthly exercise.